In today's video, I am going to be breaking down 7 ETFs that every Canadian needs to own if they want to have a high growth or just a nice stable portfolio. Let's get down and let's check these out. So the first one is ZWK. It's the BMO Covered Call US Bank. Now you're probably wondering, why am I saying that every Canadian needs to own this one? Well, there is actually a very good reason. Currently, right now with the market, there is a massive move over to high dividend, or at least dividend blue chip type of stocks, and that's what the US banks are. And this is obviously one of those times where if we get it now, for example, this could be fantastic for the next couple of years, and the dividend is insane. The dividend yield is 7.2%. Now, technically, it is a yield and not a dividend. That all comes down to the fact that this is a covered call ETF. So this means that some of that, actually most of that dividend, would be taxed differently than a regular dividend. However, you are getting a 0.71 MER, which is kind of expensive when it comes to ETFs, but when it comes to covered call ETFs, it's really not that bad. The reason why the dividend is so high is because it is a covered call. Basically, what a covered call is if you have 100 shares of, let's say, Goldman Sachs, and you have 100 shares and you want to then run a covered call against it, you would basically sell a call option against those shares, not you, but the people who own the ETF. And at that point, you get that yield, or at least that premium from that call option. And if that call option expires, you keep your shares and you, of course, keep the premium, in which case you're basically playing casino as the casino. It's a fantastic way of making extra money with your shares. Its average volume is 28,000 shares traded every single day, so it should be very easy to get in and out of. Now, there are many different YouTubers who will say never buy covered calls because their stock price always goes down. Well, there's actually a lot of covered call ETFs that don't go down, and they're mostly all ran by BMO. It's just the way they run their ETFs. It's a bit different than some of these other names. They tend to go out of the money options, which means that you tend to keep your shares. Anyways, before the pandemic, it was a very new ETF, and it rose from around just over $30 to a max of about $32.50, about $33 in that range. And then, of course, the pandemic hit, and if you got it down here like I did, you would have been well over 10%, and it's an absolutely amazing buy during that time. I was buying it about there. Since then, it has recovered, and because there was this push into blue chip stocks right there, it did spike. However, the whole market's come down recently, so that's why it's down a bit. It also pays every single month, which is absolutely amazing. It did lower its dividend recently, but remember, this is because it's getting all of its money, or at least most of its dividend, from the premiums of those call options. When volatility generally goes down in a way, the premium goes down as well, so that could be potentially why. Now that volatility is back up, you may actually see an increase, but we don't know. We won't know until they tell us. Its top stocks that it owns are, of course, some of the biggest banks in the States, but also a couple of smaller ones as well. But overall, you're getting Goldman Sachs, Bank of America, of course, Signature Bank. These are big companies. Wells Fargo, JP Morgan. These are very solid businesses. The second stock is another BMO one. Now, I promise I'm not going to be filling this all up with BMO ETFs, but ZUE. It's basically an ETF that covers the S&P 500, and the reason why I'm picking this one right now is that it's hedged. It's hedged to the Canadian dollar. In short, basically what that means is if our dollar goes up at, let's say, up 1%, and the American dollar goes down 1%, well, then you wouldn't have a 2% swing on your ETF because it's actually hedged to the American dollar, which means that if the American stock market goes down 1%, it doesn't matter what our actual currency does. It'll be only down 1% instead of 2%. However, if our dollar goes up 10% and the market goes up 8%, that doesn't mean that we only went up 2%. That means that we actually went up 8%. So overall, it's right now, with the way the currencies are going, I would lean towards hedged. Now, of course, the Canadian dollar is not doing very well right now, but you generally don't want to essentially unhedge yourself from the Canadian dollar when it's low, because when it rises back up, you're going to be losing some money. So that's just my own personal thought. That's currency games. If you don't know what I'm talking about, don't worry. It's just too confusing for 99% of everybody, so even myself at times. So definitely, if you're not wanting to get into the whole currency mindset of whatever's going on, hedged is the way to go. Its expense ratio is 0.09%, which basically means if you were to put $100 into this ETF, then you would be essentially paying BMO about 9 cents per year. Now, of course, if the stock price doubles to $200, then you'd be paying 18 cents, but you doubled your money, so it doesn't necessarily matter. And at 0.09%, it's a heck of a lot better than mutual funds. It does pay a 1.2% yield as well, and it's generally quarterly as well. Now, this is why you would buy ZUE. It's basically mirroring the S&P 500. The S&P 500 generally goes up about 8% a year, which is better than 95% of all big famous traders. This actually does better than most of those big guys who are trading money. So basically, if you want to do better than 95% of all hedge funds and 95% of all investors, just buy ZUE and you generally will do better than everybody else. Now, this is the dividends. Again, we are looking at quarterly, so how I like to do this is looking year over year, 20 cents to 21 cents. What about the year before, 23 cents? Well, there was sort of a recession during this time, so that's understandable. But generally speaking, you will have dividend increases year over year. Now, its only holding is ZSP, which is basically the exact same ETF, just unhedged. So you're probably wondering, well, why does it have an unhedged ETF as its main holding? How are they doing this hedged thing so that the Canadian dollar stays the same in here as it does down in the States? Like, how are they doing this? Well, basically, they just play currency games with 1 or 2% of the money that they have. And when they're playing currency games, somehow it's able to balance out and be unhedged. And its top holdings are literally the top 10 companies in the United States by percentage. So Apple is obviously number one. They are the largest company in the entire world. And you've got Microsoft, Amazon, Facebook, Alphabet, Berkshire Hathaway, Tesla, Nvidia, JP Morgan. This is generally why right now a big portion of the market's going down, because tech stocks are generally getting hammered. And of course, as we can see, 8 out of 10 of the biggest companies in the United States are tech stocks. So if there is a tech recession, you're generally going to have a market-wide recession. However, at the same time, this is going to still be keeping up some of the market. Berkshire Hathaway and JP Morgan. The third ETF I'm going to be looking at is, again, another BMO ETF. Again, this is not going to be a total video about BMO stocks. However, what we're looking at is ZDY. This is a BMO US dividend ETF. I like this one because it's the same idea as a Canadian XIU or whatever, where basically you're getting a Canadian high dividend ETF. This one is a US ETF, 3% yield, which is really good. Volume is not bad either. The 5-year chart is also not terrible either. You're looking at around $28 to $36 over a 5-year period while getting a 3% dividend. And it's pretty well steady. Obviously, recently we're seeing some volatility, but to be honest, it's actually pretty well in line. This is why I actually believe that the stock market still got a little bit more to go down. However, if it does, this is still a fantastic buying opportunity around $36, maybe $35 at the lowest, in my opinion. Overall, the dividend is pretty strong. They do pay monthly. However, keep in mind that they did recently have lower dividends, mainly because of the COVID recession that's happening. However, the good news is, of course, sure, it was 8 cents before, it was 9 cents, but now it's back to 8 cents from being at 7.5, so it's still not too shabby. Finally, we're out of those BMO ETFs. We are into Vanguard. This is the Canadian version of what I just showed you, the Canadian High Dividend Yield ETF. Now, Canadian companies generally pay a higher dividend percentage. This is why you'll get a 3.8% dividend. And between the last one I just showed you and VDY, these are two amazing ETFs. If you're not wanting to get into the whole currency game, if you don't want to go into a broad market ETF that will go up about 8% a year and you're looking for dividends and a safe way of getting dividends, these two ETFs are generally the best way to go because then you're getting the American market, you're getting the Canadian market. And I'm going to tell you right now, if the Canadian market truly does go into a recession because of what our governments are doing with lockdowns, then we don't have to worry, because if we put some of our money in Canada and some of our money in the States, whatever happens in Canada is not going to affect the States. Most likely, we are a much smaller economy. Our whole country is pretty much equal to California. So because of that, that way you can be more diverse. Diversity is kind of king of everything. You don't want to be all into one thing. You want to be diverse. And this one just has ridiculously high volume of 130,000 shares. You're not going to have any issues getting in and out. The MER on this one is 0.21%. So again, it is a bit higher than a broad market ETF. You are focusing on high dividend stocks. However, at the same time, sure, instead of it being a 0.11 or a 0.12, you're getting a 0.2. Not that much of a difference. You're looking at 10 cents for every $100 that you put into it or have in it. So from there, that dividend yield is covering that very easily. One thing about this, however, is the fact that you generally will be moving essentially where the banks move. I'm going to be flat out with you right now. The Canadian banks are kings when it comes to dividends. This is going to be jacked full of Canadian banks, and Canadian banks basically did nothing for that amount of time. And guess what? Banks did really well since the beginning or the middle or whatever you want to say about the bottom point of the recession of the virus or whatever. This one also does pay a monthly dividend, which is always a nice thing. To be basically honest with you, I love monthly dividends. Most of the ETFs that I own have monthly dividends, mainly because I run my own business. I don't know if my company is going to do $12,000 one month or $5,000 one month. However, if I can keep my spending under what my general low point of earnings are with my business, then I'm fine. But let's say, for example, I had maybe 1 month that was well over $4,000 or $5,000 worth of spending. At that point in time, I can just rely on my dividends and I'll be fine. So that's why I like monthly dividends. It's kind of an extra little earnings for me in case I need them. If not, I just reinvest them. And again, like I mentioned, it's pretty much jacked full of Canadian banks. You've got Royal Bank of Canada, which is the basically biggest dividend paying company in Canada. TD, which is the second biggest dividend paying bank in Canada, actually company in Canada. Then there's Enbridge, Bank of Nova Scotia, Bank of Montreal, CIBC, TC, which is TransCanada, BCE, Canadian Natural Resources, and Manulife. The only one I would be worried about here is Canadian Natural Resources and TransCanada, because those are, of course, oil companies. I understand TransCanada is getting into solar power, and, of course, Enbridge is technically an oil transporting company too, however, or fossil fuels in general. However, Enbridge is getting heavily into green energy and energy transportation. So generally speaking, a fantastic ETF. This next ETF is another really good one. It is BMO Nasdaq 100 equity hedged to the Canadian dollar. Again, hedged because we don't want to play with currency right now, at least in my opinion. So this is ZQQ. We're back to the BMO ETFs. Again, I really do like the BMO ETFs. They are usually some of the more cheaper when it comes to MER. This one's a 0.39. However, they are really well managed in my own personal opinion, and many other analysts who are online on BNN or Canadian BNN anyways, Bloomberg, whatever you want to call it. So from there, average volume is 137,000 shares traded per day. This is again another one that is very well traded. This one's been around for practically ever. However, it's going to be again matching the Nasdaq 100 biggest companies on the Nasdaq. Now this one I do have to warn you about. This was trading within a range, and a very tight range at that. It recently broke past that range. Oh, Doesn't matter. It's not just the BMO. It's all of the Nasdaq 100 ETFs, even the Nasdaq 100 itself. So where can this go? Well, there is a couple of things that we can really look at. And it's broken past this level of support right there. So what is the next level of support that we really do have? A strong level. I'm not talking about something like this. Where is a strong level of support? Well, there really isn't any until about there. So this is what kind of worries me in a way. There could be a pretty substantial drop. Do I think it's going to happen? I'm not too sure. We have to wait and see. If you're looking at buying a Nasdaq ETF at this point in time, I would definitely just maybe get in a little bit and then add more while it keeps on going down, because you can never time the bottom. And no matter what anybody says, you will never, ever be able to time the bottom. This does pay once a year. Dividends, and the highest dividend paying year it had was 2014. It has since never got back to that level, so keep that in mind as well. However, you're not buying this for the dividend. It's just kind of a nice bonus at the end of the year. You're buying it for the growth. The top 10 holdings are Apple, Microsoft, Amazon. These are all going to be tech names, and the best one, in my opinion, out of them all is going to be Tesla for growth over the next couple of years, especially as well NVIDIA, because of the graphics cards that are needed. Facebook, I have my own opinions on. I understand that they are very well set up for the future. They are very diverse in what they're trying to do. This is technically meta now. However, at the same time, I just highly dislike Facebook as a company. However, I might have a slight love affair with Alphabet because obviously they pay me. I run 4 different monetized YouTube channels. This next ETF is ZCN, BMO S&P TSX capped. Again, just a broad market TSX, 2.8%, high volume, very low MER of 0.06%, even lower than the S&P one. This is going to track the market, and again, yes, it did recently go higher before the pandemic. However, again, the Canadian banks, I'm going to tell you right now, at least in the past couple of years before the pandemic, the Canadian banks really pushed the market where it needs to go. They're literally the biggest companies in Canada, take away from Enbridge, TransCanada, and of course Shopify. Those are the 3 other companies, but the Canadian banks are a major part of the Canadian stock market. Quarterly dividends, if we look year over year, we see a little bit of a decline. Not really big surprise either, because Canada is largely in lockdown, and of course there's protests that are currently happening today and yesterday and hopefully into the future. It seems like the government, at least the Conservative Party, is kind of understanding, hey, like, we've had friggin' enough of this stuff, so maybe this is going to turn around. I really hope that Canada does not fall into a recession. I do hope that house prices at least stop increasing for a little bit. But from there, overall, the Canadian market seems to be pretty weak right now, so kind of watch out for it. But at the same time, there is a very bright future. We just need to get these mandates and these lockdowns away from us, and we need to reopen, and we need the house prices to stop increasing for at least a year, because 25% is ridiculous year over year. And considering that they've tripled over the past, I think, 6 or 7 years, that's just mind-blowing. Like I was mentioning, Shopify is one of the non-banks that are in here. Enbridge is another one. And TransCanada is actually not even on this list. Used to be when last time I looked at this ETF. However, what we are seeing is Royal Bank, TD, Bank of Nova Scotia, Bank of Montreal, see what I'm going to? CIBC. Literally 5 out of the big 6 banks are the top 10 companies in Canada, so just keep that in mind. And the last ETF we're going to break down is ZWT. This is a covered call once again. However, it is a technology covered call, so this could actually do really well right now. We can see that in the higher volumes too, but this is one of those ETFs that you would want to get in if you believe in the tech story, but want to kind of wait to see what happens with the tech companies that are, of course, on the stock market. So right now there is a massive, just everyone trying to sell tech stocks, and when that's the case, that's actually not bad for covered calls. Yes, your stock price will decline, but you will still be getting a higher dividend than you normally would be during that time, and it should decrease less than the actual, I would say, for example, a QQQ or a ZQQ, where you're getting the Nasdaq 100 or the Nasdaq top companies. Basically, a covered call tech ETF might be a good chance if you believe in the tech story, because you'll limit your downside. You're also going to limit your upside when it starts going up, but at least you'll be getting dividends during that time. Now, of course, this is a fairly new ETF. It says NA for yield right here, but I'm going to go to the actual BMO site in a second and show you the dividend. It's quite high. This started back in the beginning of last year. It did have a massive growth time, and then, of course, stocks have been going down, especially tech stocks, and specifically tech stocks. This pays a monthly dividend, currently 13 cents per share. Again, top companies, once again, basically you are essentially getting the top tech companies in the States. However, Apple is not as big of a holding as you would normally find in a QQQ or a ZQQ. However, it is still a very good ETF. Basically, seeks to provide exposure to the performance of a portfolio of technology and technology-related companies to generate income and provide long-term capital appreciation while mitigating downside risk through the use of covered call options. So this is actually the BMO website itself, and currently the annualized distribution, if it continues at the same dividend rate as it is right now, you're looking at around 5%, which is really good considering tech stocks generally don't pay dividends anyways. These are my picks for the top 7 stocks, at least right now, to hold for everybody in Canada, in my own personal opinion. Remember, do your own research. Some of these people who are online may be trying to push different ETFs. Yes, I own most of these ETFs myself, so keep that in mind. I may be one of those people who are trying to push these to make them have a higher price. But overall, these are pretty solid ETFs. Do your own research before you do anything with it when it comes to investing. Don't trust any random person online, and I'll see you guys again next time.